You've probably heard terms like stocks are up, the market crashed, or Wall Street went crazy. But what does that really mean? Who decides these prices? And why do they even move? Welcome to the Financial Frame, where we break down finance and invest into simple, understandable ideas. Today, we're tackling one of the most confusing and most important parts of the financial world, the stock market. By the end of this video, you'll actually understand how the stock market really works. Simply, clearly, and without the jargon. So let's start from the very beginning. What a stock really is. When you buy a stock, you're not just buying a random number on a screen. You're buying a tiny piece of a company. Let's say there's a company called FrameTech. It's worth $1 million and splits ownership into 1 million shares. Each share represents 1/1,000,000th of the company. If you own one share, you own 0.001% of FrameTech. That's small, but real. That's what a stock is, a small slice of ownership. If FrameTech grows, sells more products, and makes more profit, your tiny slice becomes more valuable. If the company struggles, that slice loses value. So, the stock market is really just the place where people buy and sell these slices of ownership, where the buying and selling happens. The buying and selling happens on stock exchanges, like the New York Stock Exchange, NYSE, or the NASDAQ. Think of them as massive online marketplaces, but instead of shoes or phones, people are trading shares of companies. When you open your trading app and click Buy, your order doesn't go straight to another random person. It goes through a broker. That could be apps like Robinhood, Fidelity, or E-Trade, who connects your order to the market. Your broker's systems find someone willing to sell at your chosen price, or close to it, and the trade is matched instantly. In that moment, ownership of that share transfers from the seller to you. That's it. A trade is born. How stock prices are set. So who decides the price of a stock? Not a government.
Not the company. Not even the exchange.
It's you and millions of other investors, all bidding and offering prices at the same time. Here's how it works. If more people want to buy a stock than sell it, demand goes up, price rises. If more people want to sell than buy, supply goes up, price falls. That's it, supply and demand. It's just like an auction happening every second. When Apple releases a great product or reports record profits, investors get excited. They buy more shares, pushing prices up. When a company misses earnings or faces scandal, panic sets in. More sellers, lower prices. And because millions of investors are trading all day long, prices move constantly, every second, every tick, every trade. Why companies sell stocks in the first place. But wait, if stocks are just being traded between investors, how do companies benefit? Good question. When a company first wants to raise money, it goes through an IPO, an initial public offering. That's when the company sells shares to the public for the first time. It's basically saying, hey, we need money to grow, so we're selling ownership in our company in exchange for cash. The money raised from the IPO goes directly to the company. After that, shares trade between investors on the open market, and the company doesn't get new money each time. However, its market value, or market cap, changes as investors decide what they think the company is worth. What makes prices move daily? So what actually makes stock prices go up or down day to day? There are three main factors. 1. Earnings and fundamentals. This is how much profit the company makes, how fast it's growing, how much debt it has, the real financial stuff. 2. Investor expectations. Sometimes a company can report great earnings, but if investors expected even more, the stock might fall. The market isn't reacting to what's happening. It's reacting to what it expected to happen. 3. Emotions and psychology. fear, and greed. Sometimes people panic and sell everything. Other times, they chase the next big thing. That's why markets can swing wildly even when nothing huge changes fundamentally. That constant tug-of-war between reality and emotion is what drives the daily roller coaster we call the stock market. The players in the market. Now, not everyone in the stock market is the same. There are three main players. Retail investors. That's regular people like you and me using trading apps. Institutional investors. Big players like pension funds, mutual funds, and hedge funds. Algorithms and high-frequency traders. These are computer programs that make thousands of trades per second to profit from tiny price differences. These groups interact constantly, competing to buy low and sell high, and that competition keeps prices accurate and markets liquid. Why the market matters to you. So why does any of this matter to you? Because the stock market isn't just a casino, it's a tool for building wealth. When you invest in good companies and hold long-term, you're letting your money work for you. Historically, the stock market has returned around 7 to 10% per year on average after inflation. That's why it's one of the most powerful ways ordinary people can grow wealth over time, through patience, consistency, and understanding what they own. The bigger picture. Here's the truth. The stock market doesn't move in a straight line. It crashes, recovers, booms, and corrects, over and over. But over the long run, the direction has always been up. That's because as companies innovate, economies grow, and people spend, the value of productive businesses increases. The stock market is just the reflection of that progress, with all the noise and chaos along the way. So, that's how the stock market really works. Not as a mysterious machine, but as a living system of people, ideas, and expectations. If this helped you finally make sense of it, give this video a thumbs up, share it with a friend who's still confused, and subscribe to the Financial Frame for more simple explanations about money and investing. And remember, don't just follow the market, understand it. Thanks for watching and see you in the next one.